The U.S. economy is wrapping up 2014 on a strong note, and stocks are on a tear this year. But one big question looms. What does the Fed have in store for 2015? Here with his take is David Wessel, director of the Brookings Institution Center on Fiscal and Monetary Policy. David, thanks for being here.
A pleasure.
So I think everyone's looking at 2015 as the year the Fed's most likely to raise interest rates. What do you think looks like the most likely scenario right now in terms of the timing of that?
Well, I think you're right that all signs point to this 2015 being the year that the Fed finally raises interest rates, which have been at zero since the end of 2008. It's really extraordinary. I think the betting now is in the middle of the year seems the most likely, maybe the end of the second quarter, the June meeting. A little bit depends on what happens in the world economy between now and then. But the signals they're sending and the recent strong sense that the economy is getting some momentum points to that. One thing that could interfere with that, though, is that if the economy is a little bit soft and inflation remains very low, Janet Yellen, I think she used the right word when she said patient at her last press conference. That could push it off until the third quarter. So, for instance, I noticed Goldman Sachs is calling for a third quarter increase. And there are a few people who think that it might not happen at all in 2015. But I think that reflects their pessimistic view of the economy.
Do you think that, how big of a factor do you think that these outside events, the world economy, is going to have on what the Fed does?
Well, the Fed always says that it focuses mainly on what's going on in the U.S. economy, and I think they mean it when they said that. But when you look at all the risks to the U.S. economy, most of them are coming from outside. So I think they will have to take into consideration the possibility that there'll be a little more demand in the U.S., but a little less demand from abroad, and that those could net themselves out. They also have to take account of the fact that the dollar has been very strong, and the dollar is kind of like a rate increase. It tends to tap the brakes of the economy a little bit. So if the dollar is very strong and there's no inflation, that could allow them to wait a while and let the economy enjoy low interest rates for a while longer.
Now, David, let's talk for a second about how markets could react to this. We have seen some data. We're looking at a chart right now that shows the S&P 500 actually does better in periods where the Federal Reserve boosts interest rates. But I know there is concern about spooking the markets when the Fed finally does make this move. How do you do that so that markets are ready for it?
I don't think there is any magic here, and I am certain that there will be some disruption that comes when the Fed eventually raises interest rates. You know, I'm so old that I covered the Fed interest rate increases in 1994, and the Fed thought that it had pretty much sent every signal possible to say we're going to raise interest rates. But when they raised them, there was a big reaction from the markets. It ended up contributing to a financial crisis in Mexico, and Orange County, California ended up in bankruptcy because they had sort of bet the wrong way on interest rates. So I think the Fed will do a lot of talking in order to prepare people for this. But we know that there are a lot of investors who are going to get caught unawares. And the thing that's so strange is everybody was kind of preparing for the end of Fed easy money, and they said bond rates would go up in 2014, and they didn't. So I think that makes it even harder for people to prepare for this. I do think the most likely ill effects are going to be outside the United States. There's a good story on the front page of the Wall Street Journal today about how a lot of emerging market companies have borrowed in dollars, and the strength of the dollar is really hurting them. Well, the dollar will only be stronger if people think the Fed is going to be tightening policy faster than other central banks.
Well, there you go,
that's
David.
one to watch.
I don't even have to promote our paper because you do it for me. Thanks very much for being here.
You're welcome.